I ended up just getting out. Now, am I going to care if we get down to my target? And, if I look back right now, am I going to say, darn, if I would have stayed in, I'd have made an extra 6 points on that trade? Not at all. I never care about getting out. What's most important to me more than anything else is just doing the right thing. And if you do the right thing consistently, then those little things that are doing the right thing consistently will lead to a big result at the end of the day. And no one trade should be the difference. And I think it's different for everybody. And it takes a lot of work to really become okay with that. But the reality is, who cares if you miss an entire trading day or if you miss a trade or doesn't do exactly what you wanted? None of that matters. What matters is doing the right thing day in and day out. And in order to do the right thing, what that means is you have to have a plan and a logical reason behind taking your trade. There shouldn't be any guesswork. You should know exactly what it is you're doing and why you're doing it. Interesting day overall. Daily chart. We formed a bull breakout bar similar to yesterday. Yesterday we gapped up, so it was buying pressure really before the open. And today we formed pretty much a trend from the open. But look at these two bars. Does this look like the start of a strong bull trend? Let me say it differently. Does this look like the start of a strong bull breakout that's going to reset the count and lead to some kind of measured move? Or does this look like something that's going to pull back? I think it will pull back. What I don't know is, are we going to get to 6,000 first before we pull back? And my suspicion is we may go to 59.50, close enough to 6,000, and then pull back deeper than what the bulls want before we reach the 6,000 round number. But overall, I think we will probably pull back, and I think we'll get to 6,000. I just don't know the path that the market takes. 6,000 is important because it's it's near the close of last year. I think last year's close was around 60.40, if I had to guess. But it's close enough to last year that we'll probably get there. And you can see we reached that stop entry. So we had two legs up and a buy climax after this trading range when the market was already overbought. And we had the stop entry short. And I made the comment that bears will sell it and look to scale in higher. And obviously it took a lot of bars, but the bears who sold below this bar and were willing to use a wide stop and scale in, you can see what happened. They made money in the final minutes of the session. Obviously, not really an ideal stop entry to take, but the reality is if a trader did take it, they could scale in and make money. Give me just 1 second here. And then 60-minute chart. We've been so overbought and we're so far from the 6-minute moving average that I thought the odds were high that we would probably have to pull back closer to the 60-minute moving average. And we started getting small bars here. I thought the odds were high that we'd eventually find sellers above and try and reverse down. Strong enough reversal bar, probably at least a small second leg down, but I suspect the follow through on the next hour is probably going to be disappointing. This is a Globex chart. Well, actually, it's not a Globex chart. It's a day session chart. So that means next hour, depending on what we get, we may get more follow-through selling on tomorrow, so we may gap down tomorrow, but we'll see. First bar of the day, we formed a doji, but really not a great buy above. And because of that, it's better to wait and see what we get. Better to wait and see what the follow-through looks like. 2, bull bar, good for the bulls. Probably always in long, strong enough breakout, second leg up likely. And then we got follow-through on 3. 3, strong enough follow-through bar, probably going to get at least a small second leg up. 4, a pullback, but after 3 consecutive bull bars, I suspect buyers below in at least a second leg. And then 5, bull bar closing on its high. 6, follow through. Second leg up after 1, 2, and 3. Strong enough breakout, 5 and 6, that we're likely to get another leg up, and therefore you will have bulls buying the close, betting on higher prices. 7, bull bar, good for the bulls. Looks like we're going up to 5,900, so still buy the close. 8, another buy the close bar, but body getting bigger compared to 7 and getting near resistance, the 5,900 round number, reduces the probability that we're going to go a lot higher without pulling back. But because the rally is strong, the bulls, it's still too early to be selling. Better to wait and see more selling pressure or some sort of climactic bull bar. And obviously that's what we got with 9. 9 strong enough buy climax. 60% chance we get at least a small second leg up, but it's a buy climax, and that will damages the bull rally. It increases the odds that you will have profit taking up here, and you'll have bears beginning to sell, scaling into shorts. Target for the bulls, target for the bears. You'll have bears selling above 9, betting on a test of the bottom third of bar 9 and possibly the low of bar 9. 10, not a great reversal bar, but not a great entry bar for the bulls either, and increases the odds that if 11 forms the high 1, it'll probably have sellers above. 11, high 1 buy, not a great buy signal bar, sellers above, scaling and higher, and you can see what happened with 12. 12, bear bar, closing on its low, but closed above the 11 low, so a sign of weakness by the bears. But bear bar, good for the bears, probably going at least a little bit lower. Big bar, therefore big risk. You'll have some traders who, instead of selling below 12, they'll look to sell a pullback. Where would the pullback be? We had a high 1 buy 11, and some bulls will buy above 11 and buy more below 11, trying to get out back at their original entry. And you can see what happened with 13. Traders were disappointed by 12. The bulls, that a lot of those bulls used 13 to exit their longs. 13, second entry buy, but a weak entry bar 11, and then a weak entry bar, weak signal bar 11 for the high 1, weak signal bar 13 for the high 2, probably sellers above. And then we formed an inside bar and got the bear breakout 15. 15, strong enough bar, probably going to go at least a little bit lower, but you're in the bottom third of the 9, of the bar 9 buy climax. And the rally up is strong, and therefore the odds are, even if you bought the high tick of bar 10, the odds are, if you're willing to use a wide stop and scale in, you're probably going to make money. And because of that, it's probably not all that ideal for a trader to be buying. It's probably not ideal for a trader to be betting that the market is going to go a lot lower. 16, bull bar, but not a great buy above, so probably sellers above, but I suspect we're going to test up at least a little bit higher, so I would not sell. 17, consecutive bull bars, strong enough. 2 bars, probably going to get at least a small second leg up. 18, doji, probably buyers below. And then you can see we started to go sideways for 3 or 4 bars. 21, small bar, not a good sell below, probably buyers below. And then 22, outside up, good for the bulls. We may go at least a little bit higher, but I suspect that there's sellers above, and especially sellers at the high of bar 10. 23, bear bar, but a doji, probably buyers below, and a second leg up after 22, and that's what we got on 24. 24, a little bit of a parabolic wedge. 18, 22, 24. Not ideal for the bears due to it, a parabolic wedge being it's basically, a parabolic wedge is always a tight bull channel, and you have the moving average just below in a bull trend, and therefore it's really not all that great of a sell on 24, but the odds are, because we're so overdone on the higher time frames like the 60-minute chart, I suspect you will have bears selling above bars like 10, scaling in higher. Inside bar, 25. You can call it a high 1, but I suspect there's sellers above, and we'll probably pull back, but there's probably buyers not far below. And that's basically what happened with 28, or with 26. 27, inside bar, looks like we're going to pull back. Outside down 28, good for the bears. I think always in bulls, get out below 28, bears will sell. High one buy 29, but probably sellers above in a second leg down of the moving average, and that's what happened with 31. 31, good bar for the bears, but 2 legs down. 28, 29 is the first leg, pause 30, second leg 31. Strong enough bear bar that I don't know if many bulls are going to be desperate to buy the close of 31, but at 31, if 32 is a weak entry bar for the bears, that will attract profit taking by the bears and bulls buying the close. 32, bull bar, doji, but probably buy the close and at least a bounce. And then 33, bull reversal bar, good for the bulls, but tight bear channel down to 32. There might be more traders selling above 33 rather than buying it. 34, reversal down at the moving average, still probably buyers below. And then we got a reversal up 35. 35, second entry buy, 34, 35. 35, good for the bulls. Bulls are hopeful that we get a test up to the 28 high. Entry bar, decent for the bulls on 36, so breakout. 36, strong enough for probably buyers below in a second leg. And that's what happened with 37 and 38. 38, bull bar closing on its high, good for the bulls. Probably going to go at least a little bit higher and reach the 28 high. And then follow through 39, 40, but now we have a parabolic wedge with 36, 38, and then 40. Micro channel, so really not ideal for the bears, but it looks like a leg in a trading range, and therefore I suspect there's sellers not far above. Weak high one buy on 41, so probably sellers above. 42, bear bar closing on its low, but a lot of overlap, not a great stop entry sell if you're a bear looking for a lower high major trend reversal. But it is a lower high major trend reversal, and you'll have some bears taking the trade. 43, doji, not a great entry bar, but it's not a bull bar either. And then the bears, they tried to get a bear breakout below 43 and 44, and they couldn't do it. And then we formed another bear bar, 45. Bear micro channel, but tails below the bars, a lot of overlap right at the moving average. Makes me think that we may find more buyers down here rather than sellers. Reversal 46, good for the bulls. Probably going to get at least a small second leg up, and that's what happened with 47 and 48. But after 47 and 48, we're right at the high of the 28, or 28 high for the bears, possible double top. But I suspect since we're in a trading range, we're probably going to trigger the buy above 28 and trap the weak bears out. The bears who are selling stop above, one tick above 28. And then we got a bear bar, we got a bull bar, 49 closing on its high. Good for the bulls, but possible wedge. 10, 28, 49, and a tail above the bar increases the risk that 50 is bad follow through and that we get a couple of legs down. 50, bear bar, good for the bears, probably going at least a little bit lower. Consecutive bear bars, 50, 51, probably sellers above and a second leg down. And therefore 52, not a good bull bar, probably sellers above. Outside down 53, good for the bears, probably going to go at least a little bit lower. And then 54, 55, 53, 54, consecutive bear bars, second leg down, likely. And we got a bull bar 55, but not really all that great of a bar. Makes me think that we'll probably have to fall below the 55 low at a minimum. And you can see the bulls tried to get the reversal, 55, 56, 57, but instead we got the reversal down and we went below the bar on one of these bars. At least I thought we did, 63, 64. Actually, I say that. I think we made an equal double bottom. So we made a perfect double bottom here. So the bulls, they have a double bottom, 55 low, 63 or 64 low. Bull bar closing on its high, 64. Always in bears, they probably get out above 64 or 65. And then we got the surprise, 66. Strong enough surprise. I suspect we'll probably get at least a small second leg up. But look at the symmetry of the micro channel, 64, 65, 66. 64 is an inside bar. 65 is a little bit bigger, and then 66 is even bigger. And that's really not ideal if you are looking to, that's really not ideal for a 3-bar microchannel. It increases the risk that 66 is more of a buy vacuum test of resistance, such as the 52 high. So something like this. That's the risk that the bulls face. Bad follow through 57 or 67, probably buyers below in a second leg up. And then you can see what happened with 69. 69, we formed a second leg up, and then we got a bear bar. Really not ideal for the bulls. I think it's okay for bulls to exit below 70 and then wait. And then if they did, they really don't have a credible buy above 73. And then 75, we formed another reversal down. Now we have a wedge, 66, 70, 75, 74, reversal down 75. Always in bears. I think more bears will sell below 75. And if a bear sold below 70, got stopped out above 70, above the 70 high, I suspect they sell again below 75. And then decent fall through 76 below the moving average, probably going to go at least a little bit lower. And then you can see we sold off into the close. For stop entries, you can buy above 1, but realistically, that's not something I'd prefer. I'd rather buy above a bull bar closing on its high, like bar 2, or wait and buy. If you want higher probability, wait and buy above 5 or 6. And then bulls, they can buy for any reason. And then we see a buy climax bar on bar 9. I think it makes sense to get out below 12. But if you do, maybe you buy again above a bull bar. Maybe here, 22. You don't have any bull bars closing on their highs here, so you're probably trapped out. Probably okay to buy above 22 if you're quick to make decisions. A little bit of a triangle, bull breakout above in a second leg. And then bulls, they get out below 28. Bears can sell, but they know it's a minor reversal, and therefore they got to get out above a bull bar in leg 2 or leg 3. I think it's okay to get out above 32, certainly above 35. I think you have to. If you're a bear, bulls, they can buy 35. And if they do, where do they get out? They probably get out below 42. And then as far as buying again 46, maybe, but I think it's really tough and not that great of a trade to begin with. So you may just be trapped out. Bears, they can sell 50. That's okay. We have a wedge top. I thought that was really reasonable. Sell below 50. And they can get out above 55, but I made the comment that I thought 55 was a minor reversal, and then we probably have to fall below 55, even though it took till the end of the day to do it. So bears, they can sell. Some get out here. They might sell again below 60, but if they do, they probably buy back shorts 63, 64, 65. Bulls, they can buy. They probably get out below 70. And then what do you do if you sell below 70? A little bit tricky. If you use a wide stop, you're fine. But if you use a tight stop above 70, you probably sell again below 75. And then bulls, I would not buy above 73. And that's probably it. Bears, they can sell 75. They can sell 76 for a second leg. Limit orders. No limit orders here because they never triggered. And at this point, we have a low 1 short 11. And whenever you have a low 1 in a prolonged micro channel, usually the limit order buy below is not all that great, because if you buy below bar 10, there's a problem with it. If you buy the 10 low, and let's say you set a target at the high of bar 10, what do you do when you get 11? 11 now forms a high 1 buy late in a buy climax, late in a bull trend. And therefore, there's probably more sellers above the high 1. And that increases the chances that these limit order bulls are going to sell. So if I was ever a bull and I bought the low of 11, and then I see 12 be a bull bar, or I'm actually totally wrong on my bar numbers. Let me do this so to make it more clear. Okay, let's say I'm looking to buy below a bar all the way up, and here's my entry. So I buy the low of this bar. What do you notice about buying the low of this bar? The problem is, generally speaking, if I'm going to take a low 1 on a limit order, I like to buy the low of the bar. If I think it's a really strong trade, I'll buy the low of the bar, and I'll set a stop and at 1 times the range down and a target at the high of the bar. And that will give me a 1-to-1 risk reward. But what do you notice about here? The problem is if I buy the low of this bar and I get a bull bar that is not above the 10 high on bar 11, that bull bar is a weak high 1, and therefore there's sellers above. So if you're a bull, you really need to exit above this bar because you're not going to be alone with that. And that's what happened with bar 12. And then overall, I thought buyers down here, but really tough to take that trade with being a big bear bar. And then I thought buyers below 18, probably sellers above the 10 high, but you got to I think you really got to know what you're doing, and that's tough to do. And then I thought sellers above 29 for a second leg down in the moving average. I thought that was an easy limit order trade, especially after consecutive bear bars, 28, 29. I thought limit order buy below either the below 31 or below 32, probably better below 32. And you can see it didn't trigger on 33. And then trying to make it easy limit orders. Sellers above 52. I thought that was a good limit order trade. Consecutive bear bars, second leg down likely, and late in a rally. So I thought 52 was a really good sell. And then as far as other limit orders, there's really not a ton of them. You know, if you're aggressive, selling above 70 during the bull bar, 74 for a possible wedge, I thought that made sense. And that's probably it for limit orders. Buy the close, sell the close. Buy the close 3, and then probably buy the close 6, 7, 8. What about 9? I thought 9 is more of a sell the close bar than a buy the close bar, and therefore I'm not going to buy the close of 9. 15, it's more of an opposite bar. Don't sell the close, look to buy the close. And then as far as traditional buy and sell the close, it's really opposites. So wait for 2 legs down, you see a big bear bar closing on its low, look to buy the close, or wait for hesitation and then buy. You see a big bull bar, 49, but 2 legs up, or 3. 1, 2, 3. And the third leg is subdivided into 2 legs. Leg 1, pull back, leg 2. And this leg 2 is subdivided into 2 more legs. So that makes 49. I think a pretty good sell the close bar. And that's probably it for buy the close, sell the close. Let me take a look at a couple of questions. Someone made a comment saying that the daily chart, those breakout bars look stronger on the daily ETH versus the RTH. Yeah, so what this person's saying is here. When you look at this daily chart, this does not look like strong bull bars on the daily chart. But it's really not true because this is a big gap up. So whenever you see a gap in a bull bar, you have to think about it like this because this is how traders are seeing it. And what they're seeing is a buy climax. So it doesn't matter what chart you're looking at. You know, what matters is, if we really want to get technical, we're going to look at a line chart. And what do we see? We see a channel and then a pop. So that's a buy climax, and we're far from this moving average. But the point is, or you can see it like this if you want. The point is the fact that we're gapping up and we're far from the moving average makes me think we're probably going to pull back. Okay, here's a lengthy question, so it might be a good final question for the day. Okay, someone said that they're trading a breakout follow-through system or trading plan, and they felt frustrated. They're trading a breakout follow-through system using Ali's paint bar. Okay, so you probably went to Orlando and you got Ali's paint bar, and basically there's nothing. By the way, for those who don't have that, it's just you could figure it out in ChatGPT. All Ali did is he just coded a simple paint bar that just paints a bar when the high of the bar is greater than the high of the prior bar for bulls, and the low of the bar is greater than the low of the prior bar. So it's really not that complicated. But anyways, you're trading breakouts and follow-through, and you're frustrated because you passed on 2 breakout follow-through signals that worked out, and you saw both of these signals as being in the third leg of the channel. I'm struggling with the discretionary part of the system because I hesitate to override my rules when I think entering is the right thing to do, but I have rules that conflict. In the past when I've taken the signal in the third leg. I have taken consecutive losses. Do you have any advice? Yeah, so this is actually, I'm not so much interested in exactly what you're doing because I kind of knew where your question was getting at, and that's why I wanted to bring it up. This person's trying to trade a breakout and follow-through system. So it's basically like I'm going to only trade a 3-bar microchannel, and that's my game plan. Now, the problem this person's facing is they're having trouble with the discretionary side because what they're seeing is this. They're seeing a breakout and follow-through, and then maybe, a breakout and follow-through or something like this. And, basically they're seeing breakout, follow-through, breakout, follow-through, breakout, follow-through, and they can't seem to get in the trade, and therefore they miss it, and they're getting upset. And the problem is this. This happens all the time when you're trading breakouts. When you're trading breakouts in a breakout that's really strong, you're going to see basically consecutive buy climaxes and think, oh my gosh, that's a wedge. I've got to, I can't take these trades. I can't do this because every time I take the third leg in a trading range, I get burned. Well, look right here. leg 1, leg 2, leg 3. What happens if you bought anywhere up here? You had a deep pullback and then price retested. So what you have to do in particular is understand how third legs, basically how breakouts behave in trends versus trading ranges. The stronger the trend, the more it's a breakout on a higher time frame, and therefore the more basically traders will take everything. The more it's in a trading range, the less willing traders are going to be to do that. It's kind of like this right here. This is a terrible breakout and follow through. Why? Because we're clearly in a trading range at this point, and we have 3 legs up. And if you're buying this, the market can go down, way down, really quick. So this is much different than buying this. But, the big thing is you have to really, and the other thing is you've got to define trending versus trading range behavior, because you trade it differently depending on those. All right, so that's all the time I've got today, but I appreciate it. Thanks everyone for tuning in and listening. Hope everyone is able to learn something. And if you're frustrated with trading, don't give up. There's a lot of, I think the more clarity you can get behind what it is you're exactly trying to do, the more enjoyable trading will be. But overall, that just takes a really long time. You're trying to do something that, obviously can pay you a lot of money, and no one's going to give that to you easily. There's you've heard the same story over and over, but it's hard. I think of trading like trying to be a professional athlete. There's always, nothing is going to be given to you, and you're going to have to really work hard to figure it out. If anything in life that is worth doing is going to be difficult, and trading is no exception. All right. Thanks, everyone. Hope everyone has a great rest of their day.